May 6th, 2010, 2:32 p.m. The screens on Wall Street start bleeding red. In a matter of minutes, the Dow Jones plunges nearly 1,000 points. $1 trillion of global wealth evaporated. On the trading floors, absolute chaos. The high-frequency bots that provide liquidity to the market are suddenly pulling their orders. The order book is empty. The bid-ask spread violently widens. Regulators and executives panic, assuming a coordinated cyberattacks. By 2010, human floor traders were practically extinct. Wall Street had been taken over by algorithms. High-frequency trading bots, housed in massive, liquid-cooled server farms, were executing millions of trades in fractions of a millisecond. These machines were the apex predators of the financial world. They were designed to read the order book, predict micro movements, and front-run human decisions. And their favorite playground was the E-mini S and P500, the most heavily traded futures contract on Earth. The system seemed mathematically perfect, unbreakable, until Navinder Sarao realized that if the bots were programmed to react to supply and demand, he could simply fake the supply. It's a tactic called spoofing. Using a modified, commercially available software, Sarao began placing massive, multi-million-dollar sell orders just above the market price. He had absolutely zero intention of ever executing these trades. He was building a ghost wall, and Wall Street's billion-dollar supercomputers were about to run right into it. May 6, 2010, 2:32 p.m. The trap is sprung. Sarao's software unleashes a relentless barrage of ghost orders into the market. At one point, his single algorithm accounts for over 20% of all visible sell orders in the E-mini S&P 500. The Wall Street bots read the data. They see a massive, apocalyptic wave of selling pressure coming, and they do exactly what they were programmed to do. They panic. They pull their liquidity to protect themselves. At 2:42 p.m., the floor falls out. A legitimate mutual fund places a massive sell order, but the bots have abandoned the market. There are no buyers left. The Dow Jones plunges nearly 1,000 points in minutes. Stock prices for major corporations glitch out, some trading for a penny, others for $100,000. For 36 minutes, global finance simply stops making sense. $1 trillion vanishes into thin air. And 3,000 miles away, in a quiet bedroom in London, a single trader watches the chaos unfold on his monitors. The immediate aftermath was pure, blind panic. Regulators in Washington, D.C. demanded answers. The world needed a scapegoat. The initial assumption was systemic failure, a dangerous feedback loop caused by the high-frequency trading bots. For months, the CFTC and SEC chased shadows looking at large institutional players and complex market structures. But the massive datasets didn't match the theories. Among the billions of trades made that day, there was a consistent, terrifying anomaly. The vast wave of sell orders flooding the market, representing 20% of the total volume, came from just one place. It wasn't a hedge fund in Manhattan. It wasn't a cyber warfare unit in Shanghai. 5 years after the crash, in 2015, the FBI tracked the signal to its source. They arrived at a modest semi-detached brick house in the quiet London suburb of Hounslow. When they entered the unassuming bedroom, they didn't find a sophisticated operations center. They found an isolated 36-year-old man, Navinder Sarao, still living with his parents, sitting at the same desk. Using nothing more than a modified consumer trading platform, commercial-grade internet, and the custom spoofing algorithm he called the backstop, he had outmaneuvered the billion-dollar supercomputers of the global financial elite. The ghost that broke the market was finally caught. Navinder Sarao was extradited to the United States and faced charges that could have carried up to 380 years in prison. Yet, in a final twist, He was diagnosed with Asperger's syndrome. Experts argued his extraordinary ability for identifying market patterns, combined with his compulsion to manipulate the numerical systems of the software, was the true driver of his actions. In the end, he was ordered to forfeit only his meager trading profits and served his sentence under home confinement. The real takeaway from the flash crash wasn't about punishing a single bedroom trader. It was a terrifying revelation about the modern financial landscape. Wall Street is no longer run by humans. It is a mathematical ecosystem of lightning-fast algorithms and automated systems that provide liquidity, stability, and speed. It is built to be efficient. It is built to make billions. But as we learned on May 6th, 2010, the entire system is only as strong as its fastest algorithm. And that algorithm is terrifyingly, dangerously easy to break.